Can you talk about what the business was like when you first entered, where it is today, and where you see it, say, 5-10 years from now?
I think when I started, it was 6-7 years back, and PL has always been known for its research pedigree, right? And we've consistently been one of the top-ranked institutional research houses. So when I joined the organization, the big gap that I identified was that nobody's doing quant. Quant is probably the most powerful method of research which can combine
Siddharth Vora, who's the head investment strategy and fund manager PMS at Prabhudas Lilladher.
Talk to me about how you've gone about building a team, knowing that it is a quant-specific team, and how have you thought about that entire process?
So our team structure, while inspired from science, is very, very different from that. We need to understand we're still in India. We're still a very nascent quant market and we're just getting started. My father has always told me this: you don't need to focus on getting the right answer, you need to focus on following the right process.
Have there been cases where the model has said buy stock X and every bone in your body is saying I should not do this, but you just go ahead and do it anyway?
Yeah, that happened. In fact, this last 1 year has taught me one thing.
Hi, my guest today is Siddharth Vora of PL Capital. Siddharth and I are going to talk about quant strategies, quant investing, and a whole lot more. I'm also happy to announce that Sensei Kojaku is now part of the Zerodha Collective Network. I hope you enjoy the conversation as much as I did. Hi Siddharth, welcome to the show. Thank you so much for coming on.
Thank you so much, Krish, for having me. I'm really excited for this conversation today.
So Siddharth, there's two main things that I want to talk to you about. The first is your own journey and how you are in the process of transforming a company that's been in this space for so long and in some sense updating it to world-class standards in terms of technology, and it's an important journey that all companies are on at the moment. And secondly, how investors today can use quant funds and quant strategies to achieve their goals, investment goals. So I want to start with the first topic. Can you talk about what the business was like when you first entered, where it is today, and where you see it, say, 5-10 years from now?
Sure. So I think when I started, it was 6-7 years back when I joined the organization, and PL has always been known for its research pedigree, right? Whether we talk about fundamental research, we've always had a very large institutional research team in the 30 to 40 analysts range, covering all the big sectors in India, covering more than 250 stocks in India. And we've consistently been one of the top ranked institutional research houses. We also had a very good pedigree on the technical and derivative side. So when I joined the organization, the big sort of gap that I identified was that nobody's doing quant. Quant is probably the most powerful method of research which can combine fundamental, technical, derivative, macro, valuation analytics all together in one field and leverage technology to make investment decisions. And given that PL had a research pedigree, it always was the value added player. It was never the discount guy. So I always wanted to create more forward integration within the group rather than become a discount broker or a pure digital broker. And the way I looked at the business, there were three things that I could do. One is facilitation. Facilitation means I'm allowing two people to do a transaction on my platform. I would consider that as a low value add activity. Second is consultation, which means I'm providing advice, but I'm letting the investor choose whether they want to follow the advice or not. And the final is representation, which talks about empowering the investors enough that they in fact empower you to make their decisions. Which is where I thought quant is the right fit, because quant does not facilitate, does not consult. It straight makes the investment decision. We make models, we make rules, the models make decisions. So I wanted to go to that level of automation and use of technology in the organization rather than creating another Me Too product within the financial services space. Having said that, it's been a long 5-6 year journey to build this entire quant team, It started with a 1-member team. We're now a 20-member strong quant team, one of the largest buy-side quant teams in India. And the inspiration was, I've obviously read a lot of books about a lot of investors. And I used to run a series called Acumen, which basically covered the investment frameworks and philosophies of some of the most successful global investors and applies them in the Indian context to create a portfolio, select stocks, do case studies. In this journey, I obviously came across Jim Simons as well. He's father of quant, king of quant in the world. And his track record, his history was really surprising that he's made 66% plus CAGR for 35 years plus. And he started at the age of 50. He entered the markets at the age of 50. So I'm like, this is definitely something that can be pursued. Like if you get it right, you really get it right. Yeah. And the other thing was that there were 3 main methods of managing money: active, passive, and quant. Active means a human fund manager is hired to make investment decisions. Passive means you don't really need a fund manager, you just need to replicate an index. And quant means you're using a team of strategists to make investment decisions using technology. In passive, it's a low cost strategy, so your yields are usually lower. It only allows investors to get access to market returns. Active is dependent on one individual to make investment decisions. So a lot of biases, emotions, behavioral aspects come into the picture. Quant was the third category where you can actually create alpha for investors. So the vision was to be an alpha focused investment house where all our strategies are designed to outperform the benchmark. Passive doesn't aim to outperform, neither does it underperform. It just gives you benchmark returns. And in active, the problem across cycles, across fund houses has been, as the fund manager or the CIO changes, the philosophy changes, the style changes. And if you continue the same fund manager for very long, the fund manager also develops style biases. But markets don't operate with one style across cycle. There is no one size fits all approach, right? So I had to find a way that I can create a strategy that is style agnostic and yet style adaptive. So it's not dependent on my personal investing style. It has to align with the market based on the changing market cycles. So that is how this whole sort of journey of quant has come in.
Yeah, it's interesting. My favorite Jim Simons story is he had started building a track record, done quite well. And he then increased his carry from, I think, 20 to 44%. Yeah. And so all the investors saying, went to him saying, how can you do this? How can we pay 44 is ridiculous. He's like, we sure, take your money.
He actually wanted them to
get out. No. Yeah, exactly. And they're like, no, we actually want to give you more. They were actually scared he's going to kick them out. But like you said, right, it's a strategy that if you can do it well, it's better than anything any human can do, right? Exactly. It's absolutely incredible and can be done at fairly large scale. It's not like you can only do it with like 1 lakh rupees or something. You can do it with several $1 billion. But talking about Jim Simons, an interesting thing that he did was when building out his team, there was nobody who was actually from the investment world. So it was mathematicians, astrophysicists, scientists generally. Talk to me about how you've gone about building a team, knowing that it is a quant specific team, and how have you thought about that entire process?
So our team structure, while inspired from Simons, is very, very different from that because we need to understand we're still in India. We're still a very nascent quant market and we're just getting started. So given that, I'll just give you a broad idea of what kind of people work in my team, right? So we don't have a single person who's just a comp science engineer or a programmer or who just understands finance. I need people who get a bit of both. So for example, a CFA who's also a computer science engineer, or a FRM who's a comp science engineer, or a CMT who also knows programming. So it's a combination of one financial skill and one programming skill. You need both to be a part of the quant team. And given India is still such a raw market with very low depth, we're just getting started. So Jim Simons operates at a very, very high frequency. We still operate at a mid frequency. So I do have statisticians, mathematicians, economists, all of them are also programmers in my team, but we don't operate on daily, weekly basis. We operate in a 1 month, 2 month, 3 month cycle still. So to get into pure high frequency trading, I would not need anyone with financial knowledge. I would only need data scientists and mathematicians because they have to crack the code mathematically only. We have taken a slightly different approach to quant. We call it a man with machine approach, a rules based approach, where we understand that we have 80 years of capital markets understanding, wisdom. As a group, PL as a group has been around for 8 decades now. So we understand research, we understand how markets work. As a group, we have a lot of expertise that is built over the years. So I didn't want to challenge that, neither did I want to reject that. I wanted that as a very strong foundation, a very strong base, which can be further enhanced and leveraged using quant, rather than create quant which challenges traditional investing. So I simply call it man makes rules, machine follows rules. That's the approach we've taken. I don't overrule my models or the output of my models ever. What I do is keep reworking on the process, keep improving that, keep refining that on a continuous basis. So Jim Simons and Rentech is in a completely different orbit right now, right? They don't have a man with machine approach.
Right.
They have a only machine approach. They actually believe in man versus machine.
Right.
And we are living in that world as well.
Right.
So I think as of now, we're happy with our approach. I think it retains a lot of intelligence that the human mind brings, but it also brings all the rigor and discipline that the machine brings. So our only agenda was retain the intelligence, eliminate the emotions, and convert it into rules. Convert a subjective investment thought process into objective rules. That's the journey of the last 5 years.
And you kind of had no option but to take that path in a sense, because often I've seen when there's companies that have been around for a long time and have achieved success, it's very difficult to change things, right? It's like why break something that's not, why fix something that's not broken? Yeah. So do you think that, did you face challenges converting people to sort of get on board because they think that, it's been running so well, why is this young kid trying to come in and tell me how to do my job? Did you ever face things like that?
Are you talking about clients or internal stakeholders?
No, I'm actually talking internally.
Internally, actually, people were quite supportive of this whole vision of quant, because in the last decade, people have also, seen cycles. They've understood that fund managers come in. Sometimes they do well, sometimes they don't do well. Then they leave. Another guy comes in. He does well, he doesn't do well. And over, say, 12, 15 years, 3-4 fund managers come in and go. They have cycles where they do well and they don't do well. So they also understood my broader vision was what? Make asset management process-oriented, not person-oriented. That was the first broader overarching vision. Second, ensure that investment outcomes are repeatable, sustainable, and consistent. And third, create strategies that are designed for alpha. These were the 3 overarching themes where I thought quant fits the puzzle perfectly. And just, if I look at data as well, right? 37% odd money in America is managed using quant. In 1989, only 89% of all the money was managed actively. As of today, it's 26%. So the active share has gone from 89 to 26, quant has gone from 0 to 35, 37, and passive is the other 40, 45. So that is how the world has shifted on the West. So I assume that the next decade in India is also going to see a huge transition in quant and passive from active.
Right.
Currently, the way I look at numbers, it's 82 active, 17 passive, and 1 quant. This is aggregating all the equity AUM on the MF and PMS platforms in India.
Right.
So it's 82, 17, and 1. Now this one, if it goes to 10, there's a market share gain. And there's a market size growth inherently in India as well, because every year more investors, more capital market participants. So it's looking like a very interesting journey, actually. Very excited about it.
Yeah, and I think so many fund houses either have already gotten into it or talking about getting into it in some form, right? Even if it's not the only thing that they do. But I want to now talk about how investors can use quant strategies to achieve specific goals that they have.
Sure.
Now, I'm thinking of, let's say, somebody who's already fairly well invested in the market, has, say, direct holdings, mutual fund holdings, PMS, fixed deposit, gold, real estate, a sort of multi-asset, typical multi-asset asset class investor. And let's say he says, okay, you know what, I'm approaching my retirement. I feel like I need, for example, 100 rupees a year to run my life. And let's say he has 1,000 rupees to invest. Is there some way that he can, using quant strategy specifically, say that from that 1,000, I can guarantee that I will make 100 rupees a year to live my life? Is it, or is that just, does he have to stick to FDs if he wants some sort of guarantee, or is there, using quant strategy, some way to achieve that?
First, let's just understand what is quant. Quant is not a strategy. It's an approach. It's a method to invest. Right? So within quant, we can have multiple types of strategies. Long only strategies, which means buy stocks, hold them, sell them, buy other stocks. Long only. Long short strategies, buy some stocks, sell some stocks. Multi-asset strategies, invest in different asset classes, do dynamic or tactical asset allocation. Then there are factor strategies like low vol, quality, momentum, value, single factor strategies. Then there are multi-factor strategies. So there are a lot of types of strategies within quant that you can run. But broadly, if I were to categorize within quant the methods to make money, one is a trend following approach. Second is a mean reversion approach. Third is a factor investing approach. And I'll tell you a little bit about it. Fourth is a macro approach. So macro approaches are usually used for asset allocation. Factor strategies, particularly momentum, low vol, value, quality, they are used for stock strategies, equity strategies. Mean reversion is used sometimes in derivative strategies and sometimes in asset allocation strategies as well. And trend following as a concept can be used in equities, it can be used in asset allocation, it can be used in long short. Trend following is not necessarily momentum alone. You could be following macro trends, you could be following sector trends, you could be following style trends, you could be following risk trends, you could be following asset class trends. So there are multiple larger trends that you could be following. Momentum is a very security specific factor which tells you that buy whatever is doing well. So not necessarily all quant strategies in India focus on momentum as the only factor. Today in India, every mutual fund house is allowed to have one quant strategy under the thematic category, if my understanding is correct, because as per SEBI regulations, what they specify is in every category, you can only have one fund. So if you're say running a large cap fund which is actively managed, you can't have another large cap fund which is quantitatively managed because they'll conflict with each other. One has to cannibalize the other. So no fund house usually opts for a complete switchover. So what every fund house has done is opting for that one quant strategy within their mutual fund offerings. The larger ambit of quant strategies is actually available on the AIF and PMS platforms. So for example, as a house, what we took a call was 2-3 years back, we decided to move out of active. We don't manage money actively and move into quant 100%. So now we are a true blue quant fund house. We only manage money quantitatively. And the reason is this also requires a lot of R&D, a lot of focus, a lot of specialization. And it gives you the chance to build IP-led edge, like an IP-led advantage in your strategies. So when you're taking this up, you can't be saying that, okay, I want to invest without biases. I want to be a process-oriented fund house. I want to be based on rules, factors, quant, etc. And then also run active strategies. It's confusing my investors. It's confusing my audience. It's confusing my internal teams. Which one to prefer and why and when. So we decided we'll be a pure play quant house. Now, like this, there are very few pure play quant houses in India. So if ever any investor has to make a choice between, say, an AMC which is running 30 active schemes, 15 passive schemes, one quant scheme, they need to understand that the teams are also segregated in that sort of proportion. As opposed to a pure quant house where the whole team is only quant. Day and night people are thinking, breathing, living quant. So there's a difference. And in the first 2 years, not the last two, but the first two, when I started quant, the whole effort was actually educating people. What is quant? Why are we saying quant is a sophisticated way of making money in the markets? So it was creating awareness, creating just a general education on this subject, Because we were 5 years back, we were quite early on the whole quant space. Nobody was talking about it. Now it's become a hot topic. But 5 years back when I started it, nobody really spoke about quant.
Right. So let's talk more specifically on strategies that you do employ at PL Capital. Can you talk about the specific strategies? And I know you've spoken about this a lot, so I don't want you to have to explain the whole thing in detail again in terms of Aqua and how you sort of go about the process. But if you can, the specific thing that I want to talk about actually is in the process of eliminating biases, does it also lose some of the magic, and I use magic in inverted commas, or art, or whatever you want to call it, that comes with a human being involved, where he can see things that don't appear on any paper today. So I'll give you an example. The classic example I always use is, if you were sitting in 1995, what data point would you look at that would tell you that you should buy HDFC Bank and hold it for 25 years? But by definition, there could be nothing, right? The thing didn't exist till 6 months back. So in order to do that, you had to, as a person, have that art that, okay, I can see that this is a diamond in the rough and I should hold on to it as long as I can. So now with that long prelude, let me ask you that in a quant strategy, do you by definition preclude yourself from participating in such long holding periods, or is it in aggregate, it doesn't matter because it's going to make you enough money anyway?
There are a lot of concepts that you've touched upon right now. In terms of how I want to respond to this question, there are 3-4 different investing concepts that need to come in here to create the right context for investors. Firstly, there will be very few people who would have spotted HDFC Bank in 1995 and allocated enough to it and then continued holding it through and through. So the whole concept we talk about in quant is look at a total portfolio approach. Total portfolio approach means it doesn't matter which security has given you that return. What matters is when you are giving a professional money manager your capital, at the end of 10 years, 5 years, what are you going to look at? I gave him 1 crore and what has he done with my money? Now, if I made that money from HDFC Bank, Bajaj Finance, Mazgaon Dock, Cochin Shipyard, Hindustan Aeronautics, doesn't matter. It doesn't matter. We take an equal weighted approach to investing. The whole idea is we don't want to run concentrated bets on single stocks because they are not repeatable in nature. Let's talk about a couple of these HDFC Bank, Infosys, Bajaj Finance type stories, right? They're great stories to hear. People love to hear, oh, this stock became 100 bagger. If I was even running a fund, how much percentage of my fund would have been allocated to HDFC? 2, 4, 5, 10, 30, 50? It's not going to be 50%. It's not even going to be 20%. It's not even going to be 10%. It's probably going to be 4, 5, 7%. Across cycles, how much would I have trimmed out of it? So it's very easy to know that HDFC Bank over a 15-year period had given a 30% CAGR as a single stock. Now that is a multi-bagger stock. We don't want to buy one multi-bagger stock. We are working day and night to create a multi-bagger strategy, which is very different from a multi-bagger stock. It does not rely on one stock to generate returns. So there's a concept called hit ratio and win ratio in quant. What do we talk about, right? We say that if I'm holding a 30 stock portfolio, I want majority of my stocks to beat the benchmark while I'm holding them. If that number is more than 50, you're running a very good strategy. We are operating in the 60-65% average range, which means every time I hold a stock for 2 months, 65% of my portfolio stocks beat the benchmark. This is what brings consistency, repeatability, and granularity in the portfolio. And as public money managers, that is the whole agenda. How repeatable is it to find an HDFC Bank in 1995 and find another one in 2024? It's not very repeatable. Even if I find it, how to allocate, how to hold, how to ride, how to trim, there are a lot of decisions. Now, the beauty of a quant strategy is all these decisions: which stock, what price, when to buy, how much to allocate, when to exit, when to book profits, All these decisions are based on rules and are objective. So you have a clear objective exit strategy, which I think is the most powerful advantage of a quant approach to investing.
Okay, let me ask this question, okay? If I were to compare what you are doing today at PL Capital versus what Jim Simons and team did at Renaissance, what would you say are the key or the main points of difference, and what would you say are similar between the two strategies or just generally as houses?
So firstly, nobody in the world knows what Jim Simons and his team do. There are many reasons for that. So all his employees have to sign a contract when they join the firm that they can't make any public appearances. They can't do public interviews. They don't have any investor capital. They have only employee capital. So it's a house of secrets. Nobody knows what's going on there. So firstly, because of lack of information, other than the fact that they follow quant, they follow trend following and mean reversion strategies. They are long 1,000 stocks at a given point of time, short another 1,000 stocks at a given point of time, and their average holding period is 2 days, 1 to 2 days. That's probably the only information that is publicly available out there. Secondly, India can't be compared to the Western markets in terms of how refined the quant strategies are. And thirdly, please don't ask me a question by putting me and Jim Simons in the same statement, because that guy has put 40 years of his life on this. This is just my 6th or 7th year on this field where I'm pursuing it, going deeper. So it will not be appropriate, for us to be spoken about in the same statement as well. Having said that, on the quant side, what I have tried to do in India is firstly make this subject, this concept more palatable and acceptable to Indians. In US, nobody asks enough about a strategy the way people ask in India, because for them, quant is new. What is a quant strategy? How does it operate? They want to know everything. In a US quant hedge fund, they'll probably give you a one-pager saying that this is a broad quant strategy, this is the performance, these are the back-tested results, and we follow a macro quant approach, a trend-following quant approach, a long-short quant. Nobody goes into details. Unfortunately, because it's so new in India, I had to make sure the way my strategy is designed is such that it can be explained to investors, it can be communicated. There have to be steps, there has to be a framework, there has to be a process that can be translated into human language. And that is why we have taken this whole rules-based approach, a man-with-machine approach, which I feel has helped us at least break into the investor mindset and create basic acceptance for our strategies and quant strategies in general.
It's interesting that because, so like you said, right, it's a double-edged sword, not having a large investor base that's used to your strategy or just quant strategies generally, because like you said, one, you have to spend so much time educating them, but also the flip side is you get a chance to mold a investor base in your vision, right? You can become a thought leader in that space, and of course there's that much less competition, right? It's a whole other ballgame launching a quant fund in the US or something like that, right?
So it's highly competitive.
Exactly.
As I said, 35-40% of money is managed quantitatively. So quant funds are dominating the whole space there.
Right.
And even my personal experience with US-based NRI investors, they take 15 minutes and they tell you, we are giving you money because you're a quant fund. You don't tell us why quant, we only trust quant, we are used to quant. So they just wanted to understand basic aspects of my strategy. They took 5-7 minutes to get the hang of the strategy. Because they're already used to it. And in India, you need 45-50 minutes to explain the guy what is quant, what is my strategy, why, how will this make money, why will this not fail. They have a lot of apprehensions around quant. At least 2 years back. Now I think with the kind of performance that we've delivered in the last 1 year, we've delivered close to 75.6% return absolute in our first year, which is 2x our benchmark BSE 500 and 3x Nifty 50. So with that kind of outperformance, which has come from an equal weighted portfolio, which is why the granular, repeatable outcomes. And 4 out of 4 quarters we've outperformed the market and delivered absolute positive returns. 10 out of 12 months we've delivered absolute positive or alpha positive returns. So with this consistency, repeatability and granularity in performance, investors now have much more confidence. So we've got so much more money in top-ups. So somebody started with a 50 lakhs, but he wanted to invest too. So now gradually he's just topping up without us even telling them that, okay, top up.
Right.
So I think that journey has been evolving and it's been pretty interesting.
Yeah. I actually want to talk about this equal weighted system that you have. Isn't it the case that the system would at some point say that stock X is a better buy than stock Y? I'm simplifying better buy. I'm using that in inverted commas. And so therefore, wouldn't the system itself tell you that you should put, for example, say 10% in stock X and say 1% in stock Y, just because stock X, the algorithm is telling you that, look, it's just there's a much greater chance of making money in that.
So what we do is we create a portfolio of the top 25 to 30 stocks by rank and score. What that means is every security is given a score on its quality, on its growth, valuation, momentum, volatility, sentiment, liquidity, sector strength, style, risk, lot of factors. Every security is evaluated on all these factors, and we use a relative analytics concept, which means you compare that stock versus its peer set, versus its past, and versus the broader market to determine where it stacks up. Then you aggregate these scores. But the weight to all these factors is not fixed. That is dependent on the investment regime you're in. So if I'm in a value regime, then valuation as a factor will get a little more weightage. If I'm in a quality regime, quality will get more weightage. If I'm in a low risk regime, then quality and low volatility will get more weightage. So based on the cycle, we change the weights to the factors. So finally the portfolio is top 25 to 30 stocks. Every stock has a different score. So logically, of course, rank 1 stock should get more weight than rank 2 and so on and so forth. But we don't do that because as I said, we want a strategy where bulk of my portfolio can perform irrespective of which one stock delivered the returns. So we wanted to create a team which is very robust. It's like take a cricketing example only. So in the recent World Cup also, we could hold our batting lineup till the 8th spot. Compared to say 2 decades earlier in India, the top 3 players, right? The whole team was dependent on them for getting you through. So this is creating depth in the portfolio, that your returns can come from multiple stocks. And the other thing is, we also want to think from a risk management perspective. If I have a 10% stock and that doesn't do well or corrects 40%, let's take a simple example. 10% allocation, 50% correction, 5% of my portfolio is wiped off. 3.5% allocation, 50% correction, 1.75% of my portfolio is hit. So with this, it also ensures risk management at a portfolio level. And again, as a quant house, we don't talk about stocks. We talk about the strategy. We talk about the total portfolio approach. So we have a simple metric to gauge how our strategy is doing. We call it outperformance versus underperformance. Performance means you got it right. Underperformance means you got it wrong. Whatever you did, you got it wrong. Whatever you did, you got it right. So on a 1 month basis, this is back-tested and live data since 2006. So almost 18 years now. So what this data tells us, 65% of the times, we outperform the benchmark on a rolling 1 month basis. 35% we underperform. 73% we outperform on a rolling quarterly basis. 27% we underperform. On a 1 year basis, it's 91% outperformance, 9% underperformance. And for every rebalance, it's 75-25. So 75% of all the times that I've rebalanced the portfolio, we've beaten the benchmark. 25% we haven't.
Got it. You mentioned, sorry, please continue.
So this tells you that it don't need to focus on one stock giving you that multi-bagger return. Finally focus on what the investor is going to take away, because there is a whole illusion in the markets around narratives of stocks, right? Okay, this stock became a 100-bagger in 20 years. It's great to hear, but very hard to do. We want a practical solution to all the challenges in the investing world. And this, I believe, is quite practical.
Right. you mentioned 6, 7, 8 different things that your strategy looks at, and I want to ask, my question really is, how do you know how many factors, I'm using the term factors very broadly, should be involved in decision making? And the basis of my question is a famous experiment that they did at the racetracks, where they essentially got people like gamblers who are at the racetrack and gave them differing levels of information to see what is the optimum amount of information so that they make the best decision. So obviously, if you have no information, it's pure gambling. And then they gave them like 1 metric, 2 metrics, 3 metrics, so on. And then it went up to, I think, like 80 metrics or something like that. And what they learned is that the value add of information, the incremental marginal value add, sort of peaked out at, I think it was about 20 information points. So coming back specifically to your strategies, how do you know that you are at the optimum number of data inputs or optimum number of metrics that you guys are using? And how do you know that whether you should add more, subtract, or is it just trial and error that eventually gets you there? How does that work?
Very interesting question. So I'll tell you, when we started it, you start with 5, 6 key factors which are widely covered in the world: quality, growth, valuation, momentum, volatility, etc. You build these factors. You build them in 10 different ways. So for quality, I have 10 variants of how I've defined quality objectively, quantitatively. Same for valuation, same for growth. Then you reach a stage where you realize, okay, quality best works when constructed in a certain way. So then one factor is frozen. Like that, we do it for growth, value. We freeze all factors first. That is very important. Then your next step starts. You try to bring them all together in the investment decision making. So I've started with, say, 6, 7 factors. We've now expanded to 10. We've tried 30. 20 have been rejected because they don't add value. So the whole process of quant is iterative, and at our end, it's quite logical as well. Which means we have tried to go about the whole strategy building process in a very, very logical way, where every time we construct the model, test it, we feel, okay, it's tracking and covering all of this, but there is still some sources of information which are important because we understand the markets but are not covered in our model. So we add that. We test multiple things and then 2, 3 seem to add value. So our broader number is that if we test 100 new features, 5 work, 95 don't work. But what we've done over the last 5 years is build a robust infrastructure where we can quickly ideate, test, reject, and accept new features. So what I used to take 1 year to build a strategy, 1 factor, features, now we do it in 1 day. So that whole journey has been where we've enhanced our capability and infrastructure to test strategies, build strategies faster and in a more robust way.
And how does a quant model generally react to like very sharp movements in a stock or even the market as a whole? Does it, because and often these things are, I'm just using as an example, about a month and a half back when the election results came, suddenly in that one day the market crashed, right? But an election result is not a financial factor in that sense, right? It's not a it's not a beta or
it's
something
a risk
like that.
factor.
It's a risk factor, but what I mean is it's not a financial in the sense that you could look at, I'm just giving silly examples like PE or beta or something like that generally goes into these sort of models. So how does a quant strategy, and even if you want to talk specifically on yours or just generally, how do they react to these one-off, not necessarily foreseeable, often man-made events?
Sure. So our models are built on the premise of being responsive and not predictive. We believe we definitely can't predict, and we also believe others also can't really successfully and consistently predict events, outcomes, risk events. That the biggest risk in the market is the one that is not known. Everything that is known is already factored in. So the biggest risk is the unknown risks. And we look at risks in 2 ways. Known risks, unknown risks. Known risks can be dealt with strategically through a systematic design in the strategy itself. For example, we use liquidity filters to eliminate illiquid stocks. We use fundamental red flag filters to eliminate fundamental risks around a company or a sector or a group of management. We use an equal weighted portfolio to avoid allocation, concentration, diversification risks. We rebalance the portfolio every 2 months to ensure that we are not compromising on the opportunity risk or the holding period risk or the timing risk of sorts. So these are known methods to deal with risks by designing your strategy appropriately. Now there are unknown risks which you can't predict, but your strategy still needs to be defined or designed to deal with them if and when they do happen. In the markets and in at least the world of quant, every global event, whether it's a war, a financial crisis, elections, or the budget, is a risk event because it can be quantified in terms of volatility, breadth measures, sentiment measures. So for my model, which event is happening? Not material. The fact that some risk event is around the corner, that gets captured by the data points. Because what is the market data telling you? It's a collective opinion of all the investors in the market. So when the collective opinion 1 month before the election result was very high volatility, my models know that, okay, I don't know election is happening, but I know there's something fishy. So let's get a little defensive if we can. So whether it's a war, whether it's COVID or whether it's elections, it is not the event, but the impact of that event on data points that my model is concerned about. Having said that, what we do in our strategy is we use a shield frame. It's called the shield framework. So the first aspect of shield is called shifting. Shifting means you shift risk from one to another. For example, size risk. These are all market risks. So size risk is small cap. Small cap to large cap, if you shift, you're reducing the size risk in your portfolio. Style risk. Shift from momentum growth to quality low vol or momentum value to quality low vol. You're shifting the style risk. Beta. You shift your portfolio from a high beta to a low beta portfolio. Asset. Shift your equity mix. Create some cash buffers in your portfolio. But we don't go to cash usually. In say 18 years of the strategy's backtest and live history, we've gone to cash around 12 times only.
Sorry, so when you say go to cash means what is the
50%.
cash?
50% cash is created in the portfolio, but this is only to deal with global, systemic, macro level risks which affect the asset class only. So it doesn't matter which stocks you're owning. Whatever you're owning, if it's equity, is going to correct. 2020, 2008, 2011. There have been episodes where cash is the best asset. Our models will never predict the top of the markets. But if there is going to be a 40-50% correction in the broader markets, we should be able to save at least 50% of that. So we might fall for the first 10-15% in line, but eventually our models will come and tell you that, okay, this is not a local risk. This is not a temporary risk. This is a systemic risk. Get out of the markets, create cash buffers. So for us, cash is like an antibiotic. Only if there's a serious infection or a disease do you take antibiotics. You don't take it, okay, 2 weeks later I might be falling sick. Let me just load up on. We don't do that, right? We use vitamins for that. So vitamins is all the hygiene that you design in your models to mitigate risks. That improves your immunity, that improves your well-being levels overall. So we look at it that way.
Let me ask you a question that people love asking fund managers, so active fund managers, and tell me if it has any relevance as a question to a quant fund manager. So they love going to someone in the market and saying, what do you think of the market? Is it a good time? Is it too expensive? Is it a good time to put money? So do questions like that have any, forget whether they have relevance to active fund managers, but assuming they do, in a quant fund, in a quant fund, is there any relevance to such questions?
So again, 3 things here. All of these data points matter because my portfolio color gets decided based on the market regime you're operating in. Market regime means what is the valuation regime? Are we very expensive? Are we very cheap as a market? What is the style regime? What is the risk regime? Are we in a risk on mode, risk transition mode, or a risk off mode? What is the beta regime? Are we in a high beta regime? Are we in a low beta regime? What is the sectoral regime? Are we in a market cycle where cyclicals will do better, non-cyclicals will do better, or shallow cyclicals will do better? So all these things matter, but we're talking about them in terms of words. My model processes their output and constructs the portfolio accordingly.
Okay.
So if you ask me for my personal market view, I can give you a market view that, okay, my models are saying we are currently in a risk transition regime. We were in risk on till December. Then gradually the risk on strength of the risk on regime kept reducing. And last month, June onwards, we've been in a risk transition regime. In a risk transition regime, there's a conflict to which style will do better, how your portfolio beta should be, what's your portfolio diversification. It should ideally increase when you're transitioning from one regime to another. So currently we are operating a 50 stock portfolio as opposed to a usual 25-30 stock portfolio. So yes, we do have views, but I can't show anything visually here. We have a whole quant dashboard where we have divided markets into valuation, breadth, technicals, volume, risk, sentiment, macros, asset class views, everything. And we get indicators that tell us where we are. So it is not a subjective opinion based on some news article I'm reading. I have indicators designed. I'll give you some examples, right? Percentage of stocks whose 10-day volatility is higher than their 100-day volatility.
Okay.
That's one indicator. Percentage of stocks whose P is currently less than market P. So that ratio, market P is around 21. Only 25% of the stocks have a P less than market P, which is a cyclical low.
And sorry, so when you say the universe is BSE
Top
500,
500.
yeah.
So this is a cyclical low. These kind of valuation levels have happened, say, 5 times in the last 15 years. So this is a cyclical low. So what this tells me as a interpreter of this information, that okay, markets are not cheap, they're quite expensive. What does the volatility indicator tell me? That it had peaked to 85% in June. 85% of the stocks had a 10-day volatility higher than 100-day volatility.
Okay.
Which means that the markets were very volatile. That number is now down to around 35. So we know that the volatility has come off. Am I reading this somewhere? No, I'm just seeing my data. So whether I talk about valuation indicators, volatility indicators, or say a breadth measure, percentage of stocks who've beaten the benchmark in the last 1 year, I roll this on a daily rolling basis. So we are at 82%. Now, 82% indicates two things. One, that 82% of the stocks have beaten the benchmark in the last 1 year in India. That says that the markets are fully geared on. It's a risk on regime. Second, the historic cyclical peak is in the 80-85% range. So it's an indication that there could be mean reversion. So right now, we are very strong, but the levels are such that we could see some short-term mean reversion. So this is a breadth measure that gives you a market view. So all our market views are based on all the indicators that we look at rather than my subjective 25,000, 1 lakh. We don't give targets.
Right.
Neither on stock prices, nor on Nifty levels, Bank Nifty levels, Sensex. We don't give targets. We simply tell you what we are looking at in terms of data right now.
So Siddharth, I now again just want to talk about these 3 phases that you were talking of, right? So there's risk on, risk transition, and risk off. I'm trying to gauge what investors can expect in each of these 3 phases. So can you talk about, potential sort of what investors should think of as realistic expectations in terms of return, volatility, and even sort of worst case scenarios of drawdowns and things like that?
So I think risk on is the phase that every investor, it's every investor's dream phase, right? They just want to make money. So in a risk on phase, your portfolio should have more mid and small caps. It should be fully dominated by equities. You should not have long short both exposures. You should have long only exposures. And as an investor and as a fund manager, we are aligned on one purpose: make returns and capture upside alpha. Upside alpha means market is up 20. You should target to make 40% in this phase because this will not last forever. Risk off is the other extreme. Here, neither the investor nor the fund manager are even talking about returns. The only topic is drawdown, volatility, correction. Markets are down 40%. My portfolio is 30 down. I am happy. My portfolio is only down 20%. I'm happy. So in this phase, investors are talking about how to fall less than the market. Nobody's debating whether they'll fall or not. Everybody's going to fall. How to fall less than the market. In this phase, having a concentrated large cap exposure helps. Having a low beta exposure helps. Having cash in your portfolio helps. And if you're running a long shot, then your net short should be higher. That also helps. This is the phase where you got to protect as much as you can from whatever you've earned. Risk transition is the tricky phase. You're neither saying that you want to ignore returns, nor can you ignore risk in this phase. This is the only phase where you're talking about risk-adjusted returns. You got to balance your portfolio in a way that it has the potential to, go up and beat the market. At the same time, it always has to be on the edge that anything can go wrong. So I need the defense layer also in place. So it's a balance between aggression, like attacking and defense.
Yeah.
So it's a different type of strategy. So at least investors should moderate their return expectations in a risk transition zone, have no return expectation in a risk off zone, and penalize fund managers who don't generate returns in a risk on zone. So risk on mein, it's a clean highway, drive full speed, there are no bumps, the road is good, the car is good, reach the destination fast. Risk off, focus on just managing the safety. Only focus on safety, not on speed. Risk transition, be vigilant, be cautious, maintain your speed, but at the same time, have a one leg on the brakes for managing your safety. I think that's the way to look at it.
And you're talking about how that for example, in a risk on a bull market more generally, that if a fund manager is really messed up, then you have to penalize him, right? As an investor. I know you didn't mean it in a harsh way, but the thing is that he's in a sense not done his job, right?
Because there's easy money in the market. It's for everyone to take.
That 82% of the stocks outperformed. So I'm saying if he was focused on those 18% that underperformed, I mean, something's off, right? I get it.
It's style biases.
Can have one of those.
It is style biases.
Exactly.
Only your own. So the starting point of my strategy, Aqua, was that you have to be like water. Water can change its form, shape, color, size, everything. I can't give my limitation, my bias, my inability to change my style, or my inability to invest using a certain style that is working in the market. I can't use that as an excuse to underperform. Because the markets don't really care about my personal biases, inhibitions, or limitations, right? Hence, I need a strategy that can change its style, sector mix, size mix, beta mix based on the cycle. The moment I restrict the model that only invests like this, I'm telling it, I know everything, follow me. I'm telling the model boss, I don't know everything. I will follow you, but you at least understand one instruction, that if the market changes, you also change. If the market takes a turn, you also turn. That is the whole agenda.
Right. And a question I've always sort of had with, not just with quant funds, but just generally, I think the challenge is amplified with quant funds because there's so many different things that can go into it. And often without the benefit of hindsight, it's tough to actually know what that fund manager or the algorithms that the fund manager is using is actually telling him to do and not do. So can you talk to me about how, as say as an investor sitting outside looking in, how does he gauge, that okay, I can invest with PL capital, but I can also invest with X and Y. How do I know who is actually the guy doing the right thing and who's the guy who's about to mess up?
Again, 3-4 key ways to evaluate a quant fund. The process, like what is the investment process? The performance. In quant funds, very important to look at back-tested data, look at returns, consistency of alpha, Sharpe ratio, Sortino ratio, drawdown analysis, probability of outperformance across different time periods, hit ratios and win ratios, uh, volatility measures, lot of risk adjusted return ratios. You need to look at a lot of statistical performance data. You need to look at the process. You need to look at the people behind the quant, and you need to look at the pedigree of the platform. So to summarize, process, people, performance, and pedigree. 4 things if you get, then I think that's a good enough way for you to judge if these guys are likely to do better or not.
Right. When there's an algorithm involved, there's a million data points that go in, right? And the only way the output is good if the input is good, right?
Right.
So how do you know that a given fund manager or a given house is adding the right ingredients and the right inputs? And how do you know that even with the right inputs, he's actually using it well to come out with the suitable output?
So any quant strategy, I've said this actually other time, like previously as well, it's like cooking. You start with the right set of ingredients. You need to make sure it's high quality, it's clean, it's not stale, it's bought from the right place. So for example, for us, we get all our data from Bloomberg and Accord and CMI and Reuters and different legitimate platforms. We don't save money on trying to scrape data and get free data. Then we have a whole team of database managers who cleans the data, processes the data, ensures they've written a lot of code to ensure the hygiene of the data. Then it goes to the database in a clean, structured format. Then our analysts and data scientists figure a way to use the data, add rules, processes. Then we build the strategy, test it, back test it, refine it. So it's a whole funnel. Now the idea is, let's take a simple example of a black dal, right? I can give 10 different chefs the same ingredients. All of them will cook a different black dal, and obviously one of them is going to be better than the other 9. In quant, the better and worse ka measure is very objective. It's performance, it's risk, and it's returns. There's no other measure. But in a food item, like in a black dal, 10 different people who are tasting it can prefer one over the other. So it's subjective. In quant, it's very transparent, very clear, very objective. You just look at the numbers. Now, I can have the best ingredients, but my dish can taste bad because I didn't process it well. I can have okay ingredients, but my processing is so good that the dish still tastes well. Usually when you're looking at, food, you can look at it and kind of tell that they've put food color in this, it's too oily, it's burnt, etc. In a quant strategy, you can't do anything. So there is only one simple measure: numbers, returns, backtested performance. You really need to understand this. And once you understand the performance, second basis where you need to understand the process. It's the synergy of both of these that win in the long run. If you have a good process, but it's not yielding performance, it's not really good. If you have good performance, but it's not backed by a solid process, it's not sustainable or repeatable. So you actually need both of them to bat for you all the time.
Let's take a given year, okay? There may be 4, 5, 7 days where the market as a whole, forget individual stocks, the market as a whole just goes crazy, right? It could be an election result, suddenly Russia, Ukraine are at war, COVID happens, or God knows what else, right? Think of like 87 market crash in the US, Black Friday, all of that. How does a quant model, and again, whether you want to talk about yours or just generally, how does a quant model deal with, one aspect is getting out. So maybe it can sense that there's increased volatility and therefore get out. But just as importantly, the model has to tell you when to get back in, right? You can't just get out and then, lie on a beach, right? So you have to actually get back in at some point. So how does the model figure out that the worst is behind and now it's time to get back in the market?
Sure. So I think I'll only talk about what we broadly use in our models, because talking about other models will not be appropriate here. We have a market and macro risk model, which looks at all equity asset class related domestic risks and equity asset class related global risks. Now we probably use 10 different indicators within this model, And the way to get in and get out is by setting risk thresholds. To give you an example, so when we were in school, right, you needed 40 marks in a subject to pass. And if you got 37, you needed 3 grace marks to get through. So 40 was the threshold of passing or failing. Even in this, what we kind of do is we set risk thresholds that when 6 out of 10 indicators tell me that I need to go to cash, I go to cash. The moment it falls below that 6, we go back into equities. So what happened, for example, in this election day thing is, our models did suggest us to create cash. They told us to become defensive. My large cap mix was a little more than usual. It was 45-50%. My portfolio beta was down from like 1.7 to 1.4. So we became defensive, but we didn't go to cash. Cash was like the final solution. It didn't recommend us to do that. And in hindsight, I'm glad it did, because had we gotten into cash, the week would have looked like this. Monday, I'm on 50% cash, market is up 5%. Portfolio didn't make that 5% return. Tuesday, on the election day, markets are down 7-8%. I'm on cash, I would have been like, thank God. Wednesday, Thursday, Friday, markets are rallying every day, and they've literally made up for all the losses on Tuesday. So at the end of the week, the investor would have been worse off with cash than without cash. So being deployed in equities was probably the better choice. And again, dealing with all these risks is very complicated, because as an individual investor, you still have all your emotions, right? You know that, okay, the polls are looking a certain way. You should probably have a cash buffer in your portfolio. You feel things, but your model gives you that strength, that conviction, that confidence to stay the course. And I think in tough and trying times in markets, the models really give you a very strong data-backed anchor to follow. That just follow this, because the model is telling you there is risk, but it's not so much that you need to go on cash. So I think dealing with risks objectively is good.
Right. And that's exactly the point of the model, right? That it is keeping you in check and keeping your human emotions in check, right? And so just on that point of the model essentially acting as guardrails so you don't do anything too crazy. But I'm trying to think of the other extreme, where the model is telling you something to do something, and you as a person is just setting off all sorts of alarm bells. And I know it could be one stock out of 30, 40, 50. So therefore you may say, it's fine, let's go with the model. But have there been cases where the model has said, for example, buy stock X, and every bone in your body is saying, I should not do this, but you just go ahead and do it anyway?
Yeah, that have been.
But are you okay with that? Is just that's just a fact of life now?
In fact, this last 1 year has taught me one thing, that my models are much smarter than me. And I'm better off following them than following my own instincts. Because there have been innumerous times, I can name stocks as well, where the model has decided to buy a certain stock, and I've been very uncomfortable. And there are different sources of discomfort, right? Sometimes you're uncomfortable on the valuation. Sometimes you're uncomfortable because you've seen, okay, last 1 week the stock is up 15% already. So there have been different sources of discomfort, but we've gone ahead and followed the model. And honestly, that is the reason for this performance. If I had a model to refer to and make decisions on my own, this would not be possible. So in India also, there are a lot of guys who refer to a model but make their own decisions. For me, that is not quant. A true blue 100% quant fund is all the decisions are made by the models. If you have a problem with the output, go back to the drawing board, improve the process, refine the process, change the rules. If you tamper the output, you're not following quant. If you're refining the process and following the output, that's the only situation in which you're following a quant model. And honestly, it's okay even for a model to get it wrong. As I told you, the probabilities, right? 65-35 on a monthly, 73-27 on quarterly, 91-9 yearly. These are realistic mathematical probabilities, and as investors and as fund managers, all we are trying to do is improve these mathematical odds of beating the market. That's what we're trying to do. And in this journey, there will be a lot of times when you feel like, oh, I should not be following my model. My gut is, so BSE, for example, it was, I think, 650 rupees and then it went to 750. My model decided to buy it at 750. It went to 2,500. So in the first cycle of 2 months, it bought it at 750, rode it till 1200. In the next cycle, it continued holding BSE. So for all new investors, it again bought it at 1200. In the third cycle, again bought it at 1600. So as a human, you feel like, dude, this is crazy, you know. So there are two risks here. One is I'm continuing to buy that same stock at different price points. So how will investors' performance be? So you feel uncomfortable with the price and valuation that the model is capturing and still choosing to buy a stock. The other thing is, as a sort of strategic risk mitigation tool, what we've built in, every 2 months, if a stock is continuing, you book partial profits, which means it starts at 4% weight, goes to 8%, and your model is telling you to continue that stock. You book that 8% ka excess for, bring it back down to 4, and let that 4% ride. So, in numerous examples, whether I take HAL, Cochin Shipyard, Masgar Dock, GE Shipping, Indigo, M&M, Tata Motors, BSE, PFC, REC, IRCON, lot of these stocks have given multi-bagger returns. But we have made money from them by also following our risk management practice that every 2 months, partially book the profit and let the balance position ride. So your capital is home already. You're just letting the profit ride in the stock now.
Right.
So yeah, I think at the end of it, I realized that every time I feel uncomfortable that, okay, model is throwing this stock, you still go and buy it.
So do you think you've gotten any better dealing with that, or is it just you're just going to have to live with these human emotions for the rest of your life?
Usually, now what I do is when my models generate the portfolio, I obviously look at all the scores and ranks and everything. And then I first ensure that I deploy it. Then I will let the portfolio, come to me. I process it. First, got the portfolio, check the accuracy first, deploy it. Then over the weekend, spend time on internalizing and mulling over things.
Right.
It's usually better that way. And not just me. In fact, when my models are generated, and as a team, we are reviewing it in the investment committee, a lot of people have sent me mails that, okay, these 10 stocks out of 30 stocks are not looking comfortable. The results are in 2 weeks. The result came 2 weeks back. So many personal reasons. Or this person said so and so in the interview. This brokerage has just downgraded the stock. This brokerage has already upgraded. So many things. We go ahead and buy it. And trust me, the model gets it right. Or at least in this phase of the market, the model has gotten the better of us.
Right. And actually, just talking about that phases, I wanted to ask you, so there's broadly 3 regimes that you have, right? So there's risk on, transition, risk off.
Perfect.
If, as you said, we are currently in the transition phase and we gone from on to transition, is it necessary that we only go to off from here, or is it possible to go back?
So, they don't happen in a sequence. You can go from risk on to risk off straight. You don't need to pass through transition to go to off. After transition, you can go back to risk on as well. Even risk transition, we divide it into correction and recovery. So basically, let's just make it more palatable and simple. It's a bull market.
Right.
It's a bear market. They are the two extremes. In between, there is a correction and there is a recovery. So if you want to follow a traditional classical market cycle, it's bull market, correction, bear market, recovery, bull market, correction, bear market, recovery. But all cycles don't play out like this.
Right.
This is just on paper.
Yeah, of course. But I mean, you have to have some framework to work with.
Yeah,
Like
of course.
I mean, I know nothing ever works perfectly, but at least
Gives you a nice structure to look at the markets.
Right. So Siddharth, I'm actually going to end with 2 questions. Again, somewhat more personal. I mean, first related to your work, but more your own experiences working in this industry. First, is there anything that somebody has told you that has really changed how you look at things? It could be advice, it could have been criticism, it could have been anything that really sort of changed your perspective on things.
So I think my father has always told me this, and I think this has played with me for the last, as I was growing up as well, since I was very young. So he was very good in maths, and he used to actually teach maths and chartered accountancy and all subjects for a living for like a very big part of his life, his early life. So he told me, so when I used to solve math problems in school, if there were 10 steps needed, I was good at maths. So I used to solve it in 3 or 4 steps and get the same answer. He's like, your answer is wrong. I said, no, the answer is right. He's like, no, you don't need to focus on getting the right answer. You need to focus on following the right process. And I think that whole approach of sticking to the process has stuck with me. So in all my, educational journey as well, he's been a very, very strong figure in my life in terms of guiding me, supporting me, and helping me navigate my educational life, whether it's my 10th boards or like IB or CA or CFA or CMT now or like everything else. So the way he taught me was, what he taught me was how to go about learning rather than focusing on what you're learning. So the whole focus was, if I have to finish 10 subjects, 100 chapters, don't look at it as a whole. Break it down into parts, break it down into micro units, create a process around, okay, first time glancing the curriculum, second revision, notes, Q&A, practice questions. So every time I appear for an exam or I have an Excel ready on day one with everything marked down. I literally have to do green, tick, 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 tick. I just follow the whole thing. And at the end of it, I feel, okay, I've achieved it. Without realizing that I finished so much, without taking that whole pressure on me, okay, I've done 100 chapters, so and so. So I think the early advice of that math problem, that even if you get the right answer in 4 steps, it's still wrong because you didn't follow the right process. Because he says, today you got it. Tomorrow, if you don't follow step 6, 7, and 8, you might not get the right answer. So that, coupled with how he trained me to go about cracking some of these tough exams, that combination has shaped me up in this process-oriented way. That inherently I've become very systematic as a person now in everything. So I look at markets also very objectively. I look at news also objectively. If I read a news about a certain sector or stock, I'll just class, is this good news or bad news? Will this have positive reaction, negative reaction? I look at everything with just objective impact of things in life.
Right.
So I think that is
it's a good attitude to have in a quant fund, right?
Yeah.
It's
You can't run a quant fund if you're not somehow wired to be like this.
Correct. And I finally want to ask you, in a sense, take you back to the first question and talk about your vision for PL Capital, whether it's the quant strategies or just generally as a company. What is your hope and aspiration for the company, say, for the next 5-10 years, and where do you see this company going?
So I think I've put my time, money, effort, everything in the area that I wish to build for the organization, which is asset management, that too quant-focused asset management. So we're talking about PMSs, AIFs, eventually mutual fund as well. That's the whole aspiration. And what is it called? You put your money
where your mouth is.
Yeah. So that's exactly what I'm doing right now. And the idea for quant strategies is, as I told you in the beginning, whichever strategy we run has to be alpha focused. Even if it's a multi-asset strategy, which inherently is a lower return strategy, it still needs to generate alpha versus its benchmark. If it's a low vol strategy, it still needs to beat the benchmark. So the whole one overarching focus is, whether it's long short, whether it's multi-asset, whether it's long only, irrespective of the category, the focus is going to be on alpha. Second, it should be process driven, repeatable, sustainable outcomes. Not one time I did magical multi-baggers in 1 year and then puss. That's not a approach. And finally, it should be driven by processes. So alpha focused, repeatable, and process oriented investment strategies. And my vision is not to honestly empower every individual investor to make money, because quant strategies inherently are slightly more for sophisticated investors who've got some more exposure to the markets. I think passives are a great start. Quant is the next level. So people can start with passives and then eventually go to quant, where the corpus is slightly bigger, the understanding is more evolved.
And would you ever go public? Any plans, even 5-10 years from now, for doing that?
I would assume so, yeah. In the next, would say 3 years or so, maybe 2-3 years, we do have aspirations on doing an IPO as well.
Okay, amazing. But Siddharth, thank you so much for taking the time. It was fantastic.
Thank you so much for having me, Krish. It
Yeah,
was
no.
a free-flowing conversation. So
Exactly. And thank you for, I know I caught you on a on a tough day, but thank you so much for taking the time. And I hope you enjoyed it as much as I did. Yeah.
I loved it. I hope the listeners and viewers also find the conversation as engrossing as we did, to be honest.
I'm sure they will. Thank you so much.
Great. Thank you so much.